Let's try it. It's a 20-minute question. We had like 7 minutes, so I'm kind of rushing you. Anybody remember the formula? Put the 10-year on top. Good. All right, so you do the longer bond on the top to its power. Good. In the lower rate, shorter rate. Do the fifth. All right. Now you get all of that and do what? Make sure it's the entire thing that before you do this next step. You probably can't just plug this into your calculator in order unless you use parentheses. And what are you going to do the whole thing to? Not mine is, but yeah, the longer term minus, and I do that just so it doesn't get confusing. And then what? Perfect, good. All right. What would be your guess what the rate's going to be? You make 420 for 5 years. You got to make another rate for the next 5 years. You end up with 460. It's going to be higher than 460 or lower than 460. It's going to be higher, probably around 5%. So you can kind of guess it. So right at 5%, not exactly 5%, but pretty close to 5%. All right, and then you do the exact same thing with the tips. So here, the longer one is 180. The shorter one is 140. Everything else is exactly the same. And again, you're going to expect something probably around 2.2%. And then you get the break even inflation. It's just going to be the difference in those two. 2.8, that's on the high end, right? The Fed's talking about 3%, so you're on the high end there. Now, what's the answer to question one? That one right there, right? Put this on Canvas, but that's answer. Make sure you're not going to be able to use Excel, so you'll have to make sure all these parentheses in the right place. You might write that number down, then write that number down, then do that. You know, might have to do it in stages. Really, really powerful skill to have, no question. All right. Let me bring up file. I didn't put it out there. Okay, I'll forget that. All right, let's look at the class notes. I'm going to go out to page 62. So we've looked at Allstate's financial reports. We talked through most of this stuff. There's a few things in the report. So the way I find it, like if you're interviewing for a firm, you just go to allstate.com and they're going to bring it up for their customers. You're not looking for that. So you have to go down usually to the very bottom and look for the company, Allstate Corporation, and then you're looking for investor relations. And we're looking for the statutory statements. Let's see if the 2024 is out there. And it's still not out there. Looking for the 2023. So it says it has it. There's the combined annual statement. I actually want the actual company. So I want this one here. That's the combined. This one here is the individual companies. It's working this time. So there are a couple pages I want to show you. So the jurat page. The jurat page can be useful. It shows you where they're domiciled, which is important because states dominate this, the regulatory. We'll talk about that some. It gives you their address. It also tells you who their board members are. It gives you a contact on the accounting side. Miguel Salcedo even gives you their phone number. You could email them and say you're looking for a job. No telling what he would say. I don't know if that's probably not the CFO, but might be the CFO of a subsidiary. So there's some interesting information down here. It's signed by the chairman of the board, by the treasurer, by the CFO, and then there's a special signing that's not in here, but there's a special signing by the chief actuary. They have their own separate report because the actuaries are pretty critical. So, and then they have a notary that signs it. So there's a little information on the first page. We covered a lot of this other stuff. I want to find Schedule T if I can. So Schedule T, I think is really, really helpful because it shows you what business they have in each state. It gives you their premiums, direct premiums written. What direct means is that's before any reinsurance, before they assume or cede reinsurance. And then we talk about written versus earned. You would expect California to be the largest. You would expect Texas to be the second largest, but when you look at Texas, what do you notice? It's really small. Why is Texas so small? What do we talk about with mold? What are they doing in Texas? Remember the county mutuals, the Lloyds. So, and Texas. So Texas is unique with those county mutuals. It's not something that happens in every state. Texas is somewhat unique where they're hiding business. I mean, would you expect Texas to be 1/10 the size of New York? I mean, this is all state, right? They should dominate the state. It doesn't mean they're that small in Texas. It just means they're using these county mutuals. So California is huge, 800 billion. New York is huge. Now, if you go to the life insurance side, this isn't life insurance. And life insurance, New York is often really, really small because most life insurance companies have a New York only business. They put all their New York business in a New York company. When I started at UTSA on the financial statement side, they made me do the life insurance company in New York because it's the only company we didn't have on a computer. So I had to type the whole thing. And they watched me from the conference room because the pieces of paper were this big. You don't know what a typewriter is, but putting a piece of paper that big into a typewriter, they were all sitting back there laughing at me. But Life in New York was its own business, own company. So it's a little different. P&C versus life insurance. For life insurance, New York's the issue. For P&C, Texas is the issue. But it definitely, you'd expect it to be about the size of the states. Texas, I mean, Florida is huge. Illinois is huge. Louisiana looks a little large to me. I'm not sure why that's so huge. So that's Schedule T. Not only that, but if I type the word Texas, you can find it. There's too many Texases in here. Too much Texas. Let me try it again. Let me try. Go up and set it down. I'll find it pretty soon because there are not that many left. There it is. All right. So this is pretty cool as well. These are called the state pages. Come on. So you remember that income statement we had with the premiums and expenses? They actually give you one of those for every single state. It's pretty amazing. So if you want to know what they're doing in Texas or what they're doing in, I don't know, my Tennessee, they give you all of that detail. That's pretty amazing. So as I said, the statutory blank is just full information you can't get anywhere else. Let's see. I want to show you a couple more things here. So Schedule D, we didn't have a Schedule D when we looked at consolidated, but Schedule D is where all their investment information is. There's an entry page, and then look at this. This is Schedule D Part 1A. They show you all the U.S. government bonds they own, other governments, state and territories, and these are credit ratings. NA1, that's like a triple A, double A, triple B, below investment grade. I think fours are the below investment grade. Just a massive amount of information. And then Schedule D more. You'll be amazed at this. Then they list every single bond that they own with all of this information. Do y'all know what a CUSIP is? Who's heard of a CUSIP? Anybody? Sit, what? You have a CUSIP on your tax return? CUSIP? I haven't heard it for taxes. Okay, well, maybe there's more terms for CUSIP. I don't know if CUSIP stands for something. Oh, there you go. It does stand for something. Committee on Uniform Securities Identification Procedures. That's probably not the same CUSIP you put in your tax return. Unless you're buying bonds, it's possible. If you're buying bonds, they would want the CUSIP. So what a CUSIP, well, there it is. I didn't know that. It's something new. So think of a CUSIP. It's like a ticker for bonds. So stocks have tickers, like Apple is AAPL, Walmart is WMT. CUSIPs are like tickers for a bond. And so they show the ticker number in here. I mean, there's CUSIP number in here somewhere. I don't see exactly where it is, but they list it in the, oh, here it is. Here's the CUSIP. Doesn't quite look like a stock ticker, does it? A little bit longer number. And the reason for that is Walmart only has one ticker, WMT, but Walmart might have 20 different bonds. And so you have a whole lot more detail, but pretty amazing. So here's all the, well, this is replication. We talked about that in my investment class. Schedule D, I won't show you all of it, but it goes on forever and ever and ever. They list every single investment this firm owns. How to use this information, you might think that's too much detail, but at UTSA, I dumped every single investment of our competitors. It was 113,000 securities, and we classified them so that I could compare UTSA's asset allocation to all of our competitors. It was massive amount of information, but every stock they own, every bond that they own, just incredible amount of detail. Remember before 1980, what were people doing with this? They were typing this into a typewriter. So, I mean, I don't know how they did all of this. So when I first started at UTSA, they just bought what was called the Schedule D bridge, which allowed them to get all of this out of their accounting system and put it right in their electronic. Can you imagine the productivity change between the old way with someone typing it into this new way? Just amazing. So you've seen the movies from the 40s and 50s with the typing rooms, 100 people typing. Those jobs all went away, and now it's all computers. So it's pretty amazing the amount of detail they have in this. Now, I can't tell you they had this detail back in the 50s, or if because they had the technology, they started including it. But I think it's been there for quite some time, this level of detail. And can you imagine how many typos there had to been in this information? It just kind of boggles the mind. Okay, the last thing I want to do is Schedule Y. It finds it. Come on, come on. It's not finding it. I think it's just too many pages. That's still Schedule D. This thing's 728 pages long, probably 600 of it or more is the schedule. Here's Schedule Y. I'm about to pass it up here. Schedule, even though it's down below. There it is, Schedule Y. All right. So the other thing you might do if you interview with a firm, you might look at their Schedule Y because it shows you every single company in the whole corporate structure. So if you look at this is Allstate. Here's their Schedule Y. Here's more Schedule Y. Here's more Schedule Y. That's all the companies. Did you know Allstate owned that many companies? And they sell these to each other. So when USAA started its life of New York, they just bought that shell from another company. They sold it off to them. So all of these are companies under Allstate's holding company. Here's the holding company. Where are they domiciled? That look familiar? What is that? Delaware. What does Delaware do? Delaware is the #1 place you put shell companies in. In Delaware, it makes a fortune by selling this. There's an Economist article that other states are starting to try to compete with Delaware, but y'all probably heard that a lot of companies are registered in Delaware because it saves them some pennies. So Allstate, even though it's an Illinois company, its holding company is a Delaware company. Here's Allstate Insurance Company, Allstate Insurance Holdings, Allstate Financial Insurance Holding Corporation holds its life insurance companies. Here's all its property and casualty companies. You have specific state companies. So here, what do we talk about with Texas? There's a County Mutual of Texas. Why? Because they want to charge higher rates than the state allows them, and that way they get around that regulation. Here's a New Jersey company, another New Jersey company, a lot of New Jersey companies, there's a Texas Lloyd's, another Texas Lloyd. I mean, look at this. Here's a Texas Lloyd that owns another Texas Lloyd. Why did they do that? Well, what I learned at USA is anytime there's a problem, the lawyer's first solution is create a new company. So just create a new company. My boss at one point, we're supposed to name the companies, and we've been calling it New Corp for so long. My boss said, why don't we just call it New Corp? And the lawyer's like, we can't call it New Corp because it's going to be 70 more after this. But yeah, New Corp, because we just got tired of naming companies. You can see they don't work all that hard at it. Here's an interesting one, Castle Key. And then you have an A, which is more that the P&C company has a bunch more. And there they are. AMCO, Allstate Financial Corporation, just massive. Some of these, probably most of the companies have 0 employees. They're just there as a shell, just the whole things. We had an annuity company in Life of New York that had no employees, but it had a bunch of business. It's just the nature of this. It's kind of freaky. So USAA, a good example, USAA is there on the real estate company. Real estate companies, they do business with the government. Everybody related to them has to comply with government regulations on discrimination and hiring practices. And it's not that USA want to discriminate, but it's because they didn't want to fill out all the paperwork. So they had to get that real estate company as far from USA as possible. And what did USA finally do? They sold it off and got rid of the real estate company entirely just to get rid of it. So a lot of this is to get around the regulations. But yeah, I mean, it's just crazy. Each one of these entities has an accounting financials that have to be done. Someone has to do accounting for these firms. I mean, we had 4 companies in the life insurance company, and then four or five in the property casualty side. So just massive number of companies. All right. The only other thing I might show you is just the level of detail in these companies that I've never looked at, but I'm guessing there might be something there. And that's, you got the notes to the financial statements. That starts at page 15. Someone had to type all of that. There's the notes, 4 pages, 5, 6. Notes, 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 notes. I mean, is anyone reading all of this? The state requires you to do this. You think anyone's going in and looking at this stuff? It just boggles the mind. So I never looked at the notes to see if there's information I could get. Let's say the notes don't give you what you need. You look through there, you just can't find it. So one of these years, I'll get to the end of it. I'm on page 49. Where did I start? 15. Can you imagine typing all of that before computers? So let's say you don't get enough in the notes. So the notes go to page 62. Well, the next section is called General Interrogatories. That's a bunch of questions the state asks. How many pages is that? Wow, word. What is all of that? You need all of that? So I may have told you all this story. I can't remember, but one of the things they have to report is how much people spend on travel, and they list it from the most, at least. Did I tell you all that story? Did I? Yeah, I can't remember, but yeah, I mean, that's the kind of detail in these schedules. My boss was number 1. He's like, he won. He was top on the list. And I was like number 5. I don't remember where I was. I was really high on the list. I didn't travel again after that schedule came out. But all of this incredible information, and I've never read through it. So that's through page 75. So 60 pages of this is a lot of data I've never even looked at. There's probably something good in there, but I don't want to read 60 pages to find 2 valuable pieces of information. So I don't know what they are, but it's just amazing the detail you get in here. And then Schedule D is a big chunk of it. So if you're going to interview with one of these entities, they would be really impressed if you got into some of these details and could talk about it and you understand your annual report. But you see the annual reports a lot more than just income statement, balance sheet, cash flow statement. There's a lot more to it. All right, let's finish up. I don't think I have much more on accounting. I think we talked through all of these. We click through it. Oh, the 5-year. I might have mentioned this, but the 5-year. I don't know if I can find 5-year. Here we go. 5-year historical data. If I were interviewing with a firm, I'd probably start with that schedule because it gives you 5 years of data that you can look at real quickly. Just where we saw with Allstate that they had some really bad years. So they had a great year in 2021, and then the inflation hit. They had bad years. 2020 was a great year. Why? Because everybody stopped driving and they had all these premiums. A great year. And then you had really bad years here, probably related a lot to the investment side. You can see the investment income dropped quite dramatically during those years. You can look at their premium growth. This is pretty interesting. They had a huge increase. Well, that's in assets, but you can look at assets, premiums. There's all kinds of things to look at here. The combined ratio is somewhat in here. Like, this is not quite the combined ratio. It's a little bit different, but it shows you losses, loss adjusted expenses, and underwriting expenses as a percentage of earning premiums. So you can see there's a big jump in those over time. So again, just incredible information. The risk-based capital that we talked about is on this page. Oh, look at this. Here's the 1-year loss development, and the 2-year loss development. Now, what was better, a negative number or a positive number? You want a negative because that means they reduced the reserves. So you can see they had a really bad year there. That's probably why their net income was so low. But what would the accountants say? We had a bad 2022. The actuary would say, no, we didn't. We had a bad year back here, but we didn't figure it out until here. We had to add all this to our reserves. So you can real quickly see, was that bad net income solely due to the investment losses? No, a big chunk of it was due to them having to add reserves. They used to have a lot of negative numbers, and then suddenly that. So, you know, if you actuaries interview with Allstate, you want to take some boldness and say, hey, what's to do with your actuaries? Your loss development is just huge. Look at, yeah, I noticed your 2-year loss development was $2.6 billion. I don't know if I would say that in an interview. That may be a little touchy, but that's pretty bad. If you look at their longer term history, that's a pretty bad 2-year loss development. That means their last 2 years of net income were brought down $2.6 billion because of stuff that happened more than 2 years ago. All right, so this should be intimidating and exciting because if you get in this industry, you'll learn all this, and there's so much that you're going to be intimidating because you're going to know stuff no one else is going to know. It's pretty amazing stuff. But that's out there. I don't know how many firms have it. You can't get this for USAA. You probably can't get this for State Farm. But most of the publicly traded companies do put their statutory stuff out there and you can get to it. I don't know why USAA doesn't share theirs. They probably just don't want to spend having to put all that out there on the internet. So, all right. So the 5-year data is pretty good. I forgot the risk-based capital is in that 5-year data. I forgot to show it to you. All right. Key ratios, we've already kind of talked about these: the loss ratio, LAE ratio, underwriting expense ratio. The investment expense ratio is just how much it costs them to have their portfolio managed. We talked about the combined ratio, so that we've got that already. We talked about that. Talked about the state pages. You've seen Schedule P. Boy, I think we've talked about everything. Yeah, we've talked through all of these, so I think we're good. All right, so there's your quick accounting, insurance accounting. How much of this did you learn undergraduate? Like 0.5%. I was really shocked. I was an accountant when I started. It was like so much. The expense part was pretty normal. Got accounts payable and expenses, but once you got past expenses, it's very, very different accounting. I used to tell accountants, finance majors, they should know accounting better than the accounting majors. But I don't think you're going to do that by taking more accounting classes, because you need to get out, graduate, get your industry, and then learn the accounting for that industry, because that's where the specialty is. They can't teach that undergraduate because it's just too specialized, too specific. So you just got to learn it when you get out there. All right. So now you're all CPAs. So let's try the investment side. So this is a big part of my career. I was sitting at my desk, minding my own business, and I got a call. Said, Ron, you're in a new job now. On Monday, you'll be in a department called Investment Strategy and Analysis. My boss was a guy named Stuart, actually took his place as head of equities when he retired, but they got Stuart, Bruce, and me together. And our job was to review USA insurance companies' investments and see if we should be doing it differently. It was very political, there's a lot of politics going on. And no one had really done a review like this before. There's not a lot out there. On the life insurance side, it's a science. It's precise. Life insurance actuaries know exactly what they're doing on the investment side. On the property casualty side, there's not a lot of consensus on what we should do. Most financial services companies is asset liability matching, where you're trying to find assets that help offset the risk of liabilities. For life insurance, it's pretty straightforward. You buy corporate bonds, because all their liabilities are driven by interest rates. So you need assets that are driven by interest rates. Pretty straightforward. The problem with the property casualty side is it's hard to find assets that move with your liabilities. We just did one exercise with tips and inflation. Inflation's a big deal for property casualty companies, so buying TIPS, buying inflation securities could make a lot of sense. P&C companies do have a lot more net worth than other financial services companies, so they can take a little more risk with their portfolio, so they do tend to buy stocks more than life insurance doesn't buy any stocks, banks don't buy any stocks, but property casualty companies do. So how do you find assets that match the P&C liabilities? First of all, we're talking about frequency and severity. What assets do you know that go up in value when we have a hurricane, or go up in value when we have an earthquake? They don't really exist. Inflation's important. We just saw an asset that goes up with inflation, so we do have that. You could buy home builder stocks, but no one's going to have 50, 60% of their portfolio in home builder stocks. It's too risky, it's too concentrated. You could invest in hospital or medical services for the bodily injury side, but that's actually part of their cost of goods sold. That's really not going to help you much. So TIPS is it. But I might ask the question here. How could you, well, I've got it here in the notes, but I'm gonna ask it separately. I don't know why Bill Gates does this thing right here, but so TIPS for inflation linked treasuries. What if you wanted inflation linked corporate bonds? This is something I want to try at USAA. If you remember this, bring it up early in your career, and they'll think you, well, I don't know if they'll think you're a genius. They'll think you think you're a genius or an idiot, but go for it. Flip the coin. There are inflation-linked corporates, but how could you create one? You don't have any idea how you could actually create an inflation-linked corporate. In my investment class today, we talked about replication using 2 or more investments combined to create a new investment. It's called replication. Is there any way we could create an inflation-linked corporate? So I really want to try this at USAA. Any ideas? Well, we could buy TIPS. So that gives us the inflation piece. We could short treasuries. What does that leave you with? Just the inflation piece of the TIPS. And what would we buy? Buy corporate bonds. I think this would work. I don't know if anyone's doing this. I can Google it. I'm always amazed when I Google stuff in class. I'm like, I want to cancel class and go read that article. Sure, there's a typo in there somewhere. Let's see if anyone else has had this idea. No. So this might be the only first time anyone's ever thought of this. Probably not. But I think this would be a great investment for a property and casualty company. So what are TIPS? It's a real yield plus inflation. This is a nominal yield. This is a nominal yield plus the spread. When you do this, what you'll end up with is a real yield plus inflation plus the spread. You put these bonds together. It's exactly what you want, a real yield plus inflation, which is what a TIP is. Because this nominal yield and this nominal yield cancel each other out. All right, y'all see that? I can call it the nominal real yield. Aye. So when you buy the tips, you get the real yield plus inflation. When you short the treasuries, you're shorting the nominal real yield. When you buy the corporates, you're buying the real nominal real yield. You're getting the spread. So when you combine them, the nominal real yield goes away. So you don't really care what interest rates do. 10-year treasury goes up, goes down. You're offsetting it exactly here, and you end up with essentially inflation linked corporate. If I were a finance person in a meeting, I would bring this up early in my career. It might be a really stupid idea, but it would be intriguing. They'll at least go, wow, that's interesting. I may think about it for 10 minutes and say, stupid idea. That's when you say that was, well, my professor at UTSA came up with that. If it's really stupid, if it's really smart, don't, take full credit for it. So I wish I could have tried this at USA. I think it would have been pretty impressive. You could try this at home. If you want an inflation-linked corporate, shorting treasuries is not that difficult to do. You could do it with ETFs. There are short treasury ETFs, so you could buy a TIPS. Y'all know what ETFs are? Like mutual funds that trade like stocks. You could buy a short, I don't know how to say it, but I'll say short treasury ETF, sells treasuries. So there are ETFs out there that are short the US Treasury market. So interest rates rise, they actually rise. And then you can buy corporate ETF. The problem with this is, though, you got cash going out the door on all three of these. Here, where do you have cash going out? You're buying, you're shorting, you're buying. So this would somewhat get it for you, but the problem is you've got cash, plus cash, plus cash, plus cash. Here, you spend $1,000. Here, you get $1,000. Here, you spend $1,000. You net out. Okay, so this one doesn't quite work as well, but it would kind of get you there. You could short a long treasury ETF, but the problem with shorting ETFs is your broker has to have it in their inventory. You can't short something your broker doesn't have. So you can short securities. You're selling something you don't own. You're selling somebody else's. Your broker will do that for you, but they have to have it in their inventory, and it can be tough. We were shorting tips. I had a guy, we were shorting tips a few years ago. It worked really well, but then our broker called us and said, we want the tips back. Whoever had them wants to sell them. We had to give them back. So it's tough. Shorting ETFs can be a little bit of a stretch, but I think this will work. I think it'd actually be a pretty interesting strategy. So tips probably is the best one. Inflation is the key. One of the reasons P&C companies buy stocks is because they view stocks as an inflation hedge, and stocks are kind of an inflation hedge. They're not perfect. How did stocks do in the 70s with inflation? Horribly. So how did stocks do in 2022 with inflation? Horribly. So stocks do really well with expected inflation, but if you get an inflation shock, they're going to fall with everything else. So they're not that good. So P&C companies, what do? They buy bonds. That's the most of their assets. That's probably 60, 70, 80% of them. They do buy corporate bonds. They prefer corporate bonds over treasuries. They do buy treasuries, but they prefer corporate bonds. They buy a lot of municipal bonds. The P&C industry is probably the largest group of companies that buys municipal bonds. And that has to do with the tax code. Life insurance companies do not buy municipals. It doesn't make sense for them, but it makes a lot of sense for property and casualty. USA had a pretty good chunk. And in fact, I was looking at Allstate once, I can't show you on their report, where they would have 50–60% of their assets would be in municipal bonds, which sounds kind of dangerous to me because municipal bonds are very illiquid. And so for Allstate to have 60% of municipal bonds, they have a major hurricane, they need to sell those bonds really fast. I think could be a disaster. So they're decent bonds, they're good bonds, but they are very illiquid. They buy treasuries and agency bonds. They don't like the return because it's the lower returning corporates, but they are extremely liquid. And so that's where you get your funding to help pay for catastrophes. So corporates and municipals to give you some yield, and then treasuries to give you some liquidity. They do like mortgage-backed securities. They're also very liquid, but they don't have a whole much, 5% or so. They might buy junk bonds, but it's not as high on the property casualty side as it is on the life insurance side. Life insurance bonds, a lot of junk bonds, just because they're competing on yield. They do buy publicly traded stocks, as I mentioned, for the inflation hedge, but it depends on the kind of inflation. Stocks do well if it's demand pull inflation. When inflation's going up because the economy is just really strong, stocks will do well. But if you have what we saw in 2022, where it's cost push because you have a supply chain disruption around the world and costs are just going up, stocks don't like that. They do have wholly owned subsidiaries, as you saw with Allstate. I don't know if you would have guessed how many companies Allstate has, but that looked like 100 or so, didn't it? That's a lot of companies. So they do that. They don't really think of that as an investment. That's more of a legal construct to get around the regulations. I wish I could show you Schedule Y for Walmart and Costco. I don't think you're going to see that many pages of companies. I really think it's banks and insurance companies that do that kind of thing. They don't do much commercial mortgages. Life insurers do a lot more of that. They don't do a lot of real estate other than their own building, with UTSA as one exception. UTSA has a large real estate portfolio. Even after selling off the real estate subsidiary, they still buy real estate from that company. Why? It's just too illiquid. Other than that, Allstate is pretty big in some of these other things. Private equity, UTSA did very little private equity. We're talking like $400 or $500 million. It's not much at all. Allstate does a lot more. Derivatives, we were doing a lot of derivatives at UTSA. Allstate does some. Joint ventures, UTSA did a little bit of that, but generally this is like 1–2% of assets. It's pretty small. So if you really had to summarize insurance companies, it's corporate bonds, municipals, treasuries, and publicly traded stocks. That's the bulk of their portfolio. Obviously, UTSA has a massive company-owned building, one of the biggest buildings around, because they're pretty concentrated here. But we never considered that an investment. So there's the bottom line. There's really no strong answer for that. Life insurance, pension plans, they have a pretty strong, and banks as well. It's pretty obvious what they're going to buy. There's a lot of history on that. Although those in my risk class know I don't like what pension plans do, but the life insurance side, banking side is pretty clear cut on what they buy. The P&C side really didn't. So when we did the study, they put us aside for 1 year to do nothing but work on this. It was a blast to work on it. We wrote a massive paper for it. And then after we did it, I got calls to do presentations at conferences all the time. I loved doing that until my boss discovered I was getting headhunter calls because of all these presentations, so he wouldn't let me go anymore. But it was fun. We presented to the rating agencies, the conferences, how should a P&C company invest? So we learned quite a bit. One trick I did, which I highly recommend, is we read a lot of articles, we documented the articles. And if we liked the article, we just called the author. And I don't know if you've ever thought about doing that. I've done that several times in my career, as shy as I am, and I hate calling people. I'm just scared to death they're going to say something mean to me. I just gutted up and called them, and I never had a bad call. It was just amazing. There was one guy who did a real estate paper, Dan Cashtan. We called him, and he was so ecstatic that someone read his article. He loved talking to us. There was one guy I called that Oh man, he had him on the phone for over an hour. He was so passionate about his article. He loved it. So just do it. Look him up, call them and say, hey, I just read your article. Or look him up on LinkedIn and send him an email. What's the worst thing they can do to you? They can't kill you or torture you, right? They can just say, no, get away from your kids, you bother me or whatever. But you can definitely do it. Learn from these people who are writing, read what they're writing, listen to podcasts and call the person on the podcast. Um, I don't think I showed you. Oh, what's the name of that podcast? I never gave it to y'all, did I? Oh, I can't remember the name of it. It has such a weird name. I gotta find it and send it to you. There's a wonderful podcast on the P&C industry that you really want to listen to, and there's a lot of people in that presentation that you could probably just call up, and they'd be amazed that you call them. They'd probably be very open. Use I'm a poor college student entry line. Everybody loves that. Everybody wants to help out college students. So it might get you a job as well. They might push you along. So, all right, there's the investment side. A lot more to it than that. When we did at USAA, we came up a list with, I think 17 things we had to look at. And we just took each one and presented to the exec council, each one down the list until we finished reviewing them all. For USAA, the catastrophe side was the biggest part. How liquid do we need to be for the catastrophe side? And so we spent a lot of time on that. How large could the catastrophe be? And that really influenced how much we need in treasuries and other liquid securities. That was probably the biggest part. But if I'd been smart enough back then, I would have recommended trying this. I think it would have been pretty fun. All right, so the last topic we're going to hit, in addition to working some problems on Monday, is a topic you probably think is boring, but it's actually really quite important. And that's the regulatory side of insurance. If you're going to interview with an insurance company on the finance, accounting, or actuarial side, you really need to know this side. You heard a little bit of this from our speakers, especially the two actuaries, the two younger actuaries. A lot of their jobs, when you start off with an actuary, a lot of your job is state focused. You have to pick a state and go into it. You really need to understand this industry. There's an article. I won't go through the article, but I'll summarize the article for you. I can't remember I think I might have put it out there on. Let's see. Yeah, I'll kind of walk you through the article. So this article here, it's really dated, but it's still applicable, at least the issues. So it was written by a very, very famous person. I don't know if he's still living. Y'all haven't heard of him, but if you're a P&C actuary, you'll know who he is. Let's see if he's still around. Looks like he's still alive, doesn't it? Professor of Risk. Yeah, that's got to be he. So if you're an actuary, you might read some of his stuff. He's extremely well known. He and the other one is Steve Darcy. Not the one from Married with Children, but yeah, he's another one. I would read their stuff. Really good actuary. Steve Darcy came to USAA and spoke to us. Really smart guy. I'm surprised he's still around, at least working, because he was my age when I met him, and that was like 20 years ago. So maybe he's still going. But essentially, what Cummins and I don't know Mary Weiss, essentially what they're asking is, why are there so many problems in the auto insurance industry, and is regulation helping it or hurting it? That's their argument. So it's a very old article, but their discussion, it makes a lot of sense. Auto insurance premiums are rising a lot faster than general inflation. For some, the cost of the insurance is approaching the price of their vehicle. So what has gone now? This is the question they ask: what has gone wrong, and what, if anything, can be done to solve the problem? That's not what they're answering in this paper. What they're answering in this paper is regulation the solution or the problem, right? So I do want to walk through this. Before I do that, I want to show y'all one quick thing. There's something really cool I found. I don't think it applies to any of your papers, but just in case. So this is a New York Times article. Oh, it's not gonna let me in. Oh, how frustrating. But anyway, it's huh? Oh, is that gonna let me? Wow. Okay, Nathan, you solve all my problems. Can you take this class again next semester? All right, so see where home insurance policies were dropped. So this is a huge issue. It might relate to the global climate change group, those that doing, climate change and what the impact is, because obviously all the drought and the fires in California is part of this. But you put your state in, and it shows you how many people policies are not being renewed in each state. And you can bring in California. It shows you really going up. Florida is another one. Florida even more so, 1 in 50. Look at that, this huge increase. You would think states along the coast would be high, and sure enough, Louisiana. So it's a pretty cool article. So any of y'all want this, maybe I can get it to you. But as climate shocks get worse, so it's who's the climate change group? Yeah, which one that is? Is that okay? So Jonathan's group. So you might be interested in this. So renewal rates were second highest in the country in 2023. The low-lying coast rate. So they give you a specific article. I mean, it's pretty amazing on a website. You change the state and it tells you Texas faces elevated hurricane risk along its Gulf Coast, storm risks. You do a state that is not known for insurance rates being high, like Montana, because there's not many houses there. But even then, they spiked with the highest rates in wildfire. I don't know if I can think of a state that wouldn't be an issue. Maybe Nebraska. Nebraska probably has some wildfires. Yeah, they all jump. So non-renewal, people are having trouble finding homeowners insurance. What industry hates this? Talk about real estate agents, so you see that. But and then they have this map, which is actually the entire US. And the darker the red, the more non-renewal there are. You can see Florida and California, and then some on the coast, along the coast. I don't know why this is probably tornado related, but these are the areas that are having the biggest problem. So let's see if I can find, I think I saw 4, there you go. Policies were not renewed in 2023, 1 in 14. 1 in 14 policies. That's a 650% increase from 2018. I don't know if you can find the highest one of all. That one was pretty high. And in other places, 1 in 103, 2.9% increase. And then up here, 1 in 278, 1 in 691, almost no one was non-renewed. So I don't know if it's too late for the climate change group, but you might want a picture of this to put into your paper. You can just see it, right? The areas that climate change supposedly impacts, fires and mudslides in California, hurricanes along the coast. The only place you don't really notice it is along the coast of Texas, which is kind of interesting. But and I don't know what these little dots mean. Maybe that's just really small territories. But anyway, pretty cool. Jonathan, I'll forward this to you. And then if your team wants it, I mean, you don't have to use it, but it could be interesting. The other thing I wanted to show you, so we'll do regulation on Monday, but I got this in the mail. Does this look familiar? Don't look at my address, but Possible federal asbestos claim to whom it may concern. If you or a family member worked in any of the industries or occupations shown on the back of this letter, or you believe you've been exposed to asbestos, you may be entitled compensation from companies that manufactured or sold asbestos. Have y'all gotten a letter like this? I haven't seen one of these in years. You may also qualify if you worked with or around workers in these industries. Our office can investigate, pursue, and file possible claims for individuals who worked with these starting no later than January 1st, 1981, no later than. So you guys are out of luck. I don't think you could have gotten exposed that far back. It's not no earlier than, it's no later than, and worked around these for at least 5 years in total. So we're talking about people who are, they were working. I was still in college in 1981. So we're talking people who are already working. So they've got to be, 5-10 years older than me, which it's hard to believe they're still alive. So it's a long time back there. We're currently scheduling X-ray appointments. All of our work is done on a contingency fee basis, so you don't have to pay us anything. Didn't Judge Jack fix all of this? So please call us or visit us. Someone should go into their website and see what's there. Federal Asbestos Trust money has been set aside to compensate workers who have been exposed. Also, if you or a loved one developed one of the following cancers, so they list the one, there's mesothelioma, the most important one of all. You may be able to pursue claims for compensations. Please contact us. Is that the same phone number again? Yep. Or visit us to discuss this matter. Lastly, if you know of coworkers, family, and they're like begging for customers here. So anyway, it's still going on. They're still being asked. I'm surprised this late in the game they're still doing this, because I thought all these have pretty been worked out. But anyway, so all right, I'll let you out a little bit early. Any questions on anything? Y'all know what we're doing on Wednesday, right? I will put this thing we did tonight out there, and there's also problems, the other math problems that we'll probably work on Monday.